Hey guys, welcome. My name is Bennett Tchaikovsky, and I want to thank today one of my viewers. Sounds like so fancy. No, I want to thank one of my YouTube viewers, Beth, who basically made a request for this video. And so this is for you. Welcome to Wiley. This is the 17th edition Intermediate Accounting Problem 24-3 walkthrough. The textbook authors are Don Kieso, Jerry Weygandt, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2023 by Bennett Tchaikovsky. All rights are reserved. The opinions contained herein are mine and are not the authors of the text or of Wiley. So let's go ahead and take a look at this problem 24-3. So as I look over here, I've got a meowing cat. So if we're going to get Zoom bombed by a kitten, hopefully we will. But let's just take a look at this. So Bradburn Corporation was formed 5 years ago through a public subscription of common stock. Daniel Brown, who owns 15% of the common stock, was one of the organizers of Bradburn and is its current president. The company has been successful, but it is currently experiencing a shortage of funds. On June 10th, 2021, Daniel Brown approached the Topeka National Bank asking for a 4-month extension on two $35,000 notes, which are due on June 30th, 2021 and September 30th, 2021. Another $6,000 note is due on March 31st, 2022, but he expects no difficulty in paying this note on its due date. Brown explained that Bradburn cash flow problems are due primarily to the company's desire to finance a $300,000 plant expansion over the next 2 fiscal years through internally generated funds. The commercial loan officer of Topeka requested the following financial reports for the last 2 fiscal years. Okay, so then we get over here, we get, basically the balance sheet, we get the income statement. Okay, so first thing it's asking for is the current ratio. Okay, so part A, compute the following items for basically for Bradburn Corporation. So our first thing we're going to do is we're going to do the current ratio. What is the current ratio? It is going to be current assets, meaning are they electrified? No, they're not electrified. We're going to be using those in the coming year. So we're going to have current assets divided by current liabilities. Okay, so when it comes to over here, we need to go through and look here, and let's go ahead and look at this. We'll do this first for 2020. Now, I see this over here. It says cash, notes receivable, accounts receivable, inventories at cost. And the thing I don't know is that are these notes receivable current or are they non-current, right? And, based on when you prepare a balance sheet, you need to do so in the order of liquidity. So I'm going to make an assumption here that these notes receivable are in fact going to be current. So what we would do is we would say 12,500 plus 132,000 plus 125,500 plus 50,000, right? Those are all the current assets for the company. Now, the current liabilities over here, we have to kind of think about this. As of 2020, we know that the accounts payable will be current. But however, the notes payable as of March 31st, 2020. Okay, this is where we get into some interesting things, because if the two $35,000 notes, I'm just going to assume that these are going to be non-current as of 2020 because it's due beyond a year from the balance sheet date. So as I look at this over here, like this $6,000 accrued liabilities is March 31st, 2022. So I'm going to just assume that the 61.5 and the 6, that these amounts over here are going to be non-current. Now, what's kind of troubling about this is that if I'm looking over here at notes, this is showing over here basically 230. So these are due on June 30th, 2021. So these are going to be non-current. But the accrued liabilities, that generally is going to consider to be a current asset. So what I'm going to do here is I'm going to say 91,000. Right, we know that the payables are going to be current plus the 6,000 of accrued liabilities. And again, so we'll say 9K AP plus 6K accrued liabilities. Here, it's going to be the cash plus the notes receivable plus the accounts receivable plus the inventory. Remember here on the note receivable, I'm assuming it is current because if they're showing us this over here, it should be in order of liquidity. What's funky about this is that you would really want to go through and see this, being better described. So that's what we're doing. So we're going to assume that basically for this particular period, that our current liabilities are just going to be 97,000. So my current ratio for 2020 is going to be over here at 2.83. Now, is this a bad thing or a good thing? Well, it depends on the company that you are, and it depends on the industry that you're in. Generally, that's going to be okay, provided that they have like when you're looking at these current assets, that it can be something where, again, it depends on the industry that you're in. Generally, something above 1 is good, meaning that they can make their payments. However, I want to caution you that if you have a lot of current assets that are not considered to be like liquid, that's going to be a problem. So let's go over here and do this. Go ahead and do this for 2021. So for 2021, we'll go ahead and do this over here as the ratio. My current assets, we're going to say is going to be 18.2 plus 148,000 plus 131,800 plus 105,000. So those are my current assets. Now, when I'm going to my current liabilities, because these notes payable are going to be payable within a year of March 31st, 2021, we're going to actually move those into current. So this is going to be 79,000 plus 76,000 plus 9,000. So that's going to give us 164,000. Okay, so this is going to be 79 plus 76 plus 9 or 164. When I do the current ratio here, we notice that it's gone down. Well, why has it gone down? Because I have more liabilities that are coming due soon. So again, current ratio, is this okay? I generally don't like the current ratio. The one I like is the one that they're doing here, which is basically going to be the acid test or quick ratio. So the acid test or the quick ratio is basically saying very current assets, meaning cash, current AR, plus marketable securities, right? And this is going to be divided by current liabilities. Now we get into this problem again that I don't have enough information about the notes receivable. Are these really current? And the challenge here is when you see a note, well, why is it a note instead of AR? Because it denotes that it has interest on it, right? So this is where we have to kind of be mindful as far as like going through and looking at this. So this is basically the formula for the acid test ratio or the quick ratio. Let's go ahead and make this a little bit easier on ourselves. So we already know that the current liabilities, we're just going to go ahead and use what we used up here for the current ratio. But over here for 2020, what were my very current assets? Well, we're going to say it's cash, notes receivable, and AR. So this is going to be 12,500 plus 132,000 plus 125,500 or 151,200. So the quick or the acid test ratio is going to be 1.56. Over here, my current ratio is going to be my acid test numerator is going to be my cash of 18.2 plus the 148,000 of notes receivable plus the 131,800 of accounts receivable. We generally do not include inventory, right, in our quick assets unless it's, so over here, this is improving slightly, right? But again, a lot of questions I have up here in terms of the way that this is being worded. And to that effect, I am going to check something really quickly. Okay, so I just checked the answer key, right? And I actually have an error on this. If you look at this over here, I put 5,000 instead of 50,000. So this is 320. So looking at their answer key, so this is actually, these numbers here are correct. Now, what's also interesting here too, is that as I'm going through and looking at this, they're actually counting this notes payable, this 61.5, as a current liability. And again, I'm like looking at this question, and I can tell you right now, this is why when I see this kind of stuff, it's like you're being too vague, right? It's always better to be more specific, but they're making the assumption that basically when it comes over here, that all the liabilities are current. So that's how we're going through and getting those responses. Okay, so over here, though, the way that I also went through over here and basically said that, okay, so the other thing I messed up on is that in terms of the current assets for basically this is going to be 12,500, 132,125, 500, or 270,000. So that number over here was correct. So let's talk about this real quick. When we look at the acid test versus the current ratio, the only number that's dropping out is the inventory, right? Because that is not considered to be a quick asset. They're considering everything else, though, to be. Also, with the liabilities, even though we're given bad information on this part over here, they're considering the notes payable, accounts payable, and accrued liabilities to all be current. So again, this is something that, like, when I give exams, and I hate giving this as a test because when you're dealing with financial statement analysis, it is very subjective. It's very, very hard to test. Teaching it really can only be done through a paper. Okay. Now we're asked to do the inventory turnover for 2021. So the inventory turnover is going to be my cost of goods sold divided by my average inventory. And we're just being asked to do this for 2021. So when I look at this, the average inventory is my beginning plus my ending divided by 2. So over here, my average inventory is going to be 105,000 plus 50,000 divided by 2, or it's going to be 77,500 is my average inventory. My cost of goods sold for 2021 is 1,530,000. So my inventory turnover over here is at about 19. Now, when I look at this number over here, what does that mean? Well, it means that my inventory is turning over 19.74 times a year. A very quick way to see, well, how many days are we taking to turn over our inventory? If I take 365 divided by this 19, this is telling me that it's taking me approximately 18.48 days to convert inventory to cost of goods sold, which is good because it means we're going through and doing it quickly. So that's basically an example for inventory turnover. Now we get to return on assets. Okay, so return on assets. I have a feeling this is like average total assets divided by, I can't remember what that one is. So return on assets. So what is ROA? It's basically net income divided by, should be the average total assets, meaning what were my total assets at the beginning, the ending. So my return on assets is going to be my net income divided by my average total assets. Okay, and my average total assets is going to be my beginning assets plus my ending assets divided by 2. Okay, and they're also asking us to do this for 2020. So let's go ahead and have some fun. Okay, so for 2021, my net income was 366,000. My average total assets for 2021 is going to be 1,852,000 plus 1,740,500 I'm going to divide this result here by 2. So my return on assets is roughly over here at about 20.38%. Okay, so again, this is just telling me what is my, what kind of return am I getting on my total assets. It's taking net income divided by my average total assets. Over here for 2020, my net income was 297,000, right? So I've got 297 and my average total assets are going to be 1 million. Okay, so right over here. So I've got 1 million. Okay, so I got 1,745,000 and my assets are 1,688,500. Okay, so right over here. And I think that might be correct. Okay. So let's go ahead and take a look. 17 point, that looks good. Okay. So here is this is my return on assets. Okay. So that's my next one. And then over here, my percentage change in sales, cost of goods sold, and net income after taxes from 2020 to 2021. Okay. So for this, they're asking change in sales revenue, cost of goods sold, gross margin, and then my net income. Okay, so the way we do this is I would say 2021, 2020 sales revenue, 3 million. 2020 was 2.7 million. Okay. Over here, cost of goods sold, 1,530,000, 1,425,000. Gross margins, 1,470,000. Gross margin for 2020 is 1,275,000. My net income is going to be 366 and then 297. Okay. When I'm being asked to do a percentage change, this is how I want to go through and do it, and not like that. Okay. So here's how I want to go through and do it, right? So my difference basically from 2020 to 2021, 300,000, 105, 195, and then 69,000. Now, to do this, so this is a dollar difference, right? So this is between 2021 and 2020. If I call this A, this B, A minus B equals C. If I want to show this as a percentage change, I can difference and divide it by B equals D, or the percentage change. So what this is telling me is that if I go through here, my sales revenue increased by 11%. If I want to check my work, I take 2.7 million, multiply that by 11.11%. That's how much it increased by. I add that amount to the base amount of 2.7 million, and then I get the 11.11%. So we're going to go ahead and do this over here. So my cost of goods sold increased, my gross margin increased, and then my net income also increased, okay, by those percentages. So as we see this over here, in terms of the percent changes, that's how we would go through and do that part. Okay, so right over here. So the problem here for Beth, right? So we're moving right along. Okay, so part B, identify and explain what other financial reports and or financial analyses might be helpful to the commercial loan officer of Topeka National Bank in evaluating David Brown's request for a time extension on Brad Burns' notes. So a couple different things is that when we're going through and looking at this, right? So this is, this looks like it is a publicly traded company. And so what I would really be kind of concerned about here is like, you would also probably want to see, what do we not see here? We don't see a statement of cash flows, right? What I can also ask for too is that I might want to also recheck up on the backgrounds of the various different, basically like officers and directors of the company. The other thing I may be able to ask for, and again, it can be kind of tough, but I would need to be under a non-disclosure agreement, meaning that if Bradburn Corporation is publicly traded, I may need to ask them for insider information in order for me to make a decision. What that would mean is that I might ask them for some internal cash projections. I might want to ask them for a projected cash flow. Right? What does that mean? You're asking, okay, what does your cash balance look like for the next 12 months? How are you converting your sales into cash? Right? And other things too, they kind of mention over here is like, you may want to also look at how quickly are the receivables turning over. And that is probably a more relevant question than the inventory, because this constitutes a much greater percentage in terms of total assets. Right. The other thing too is like when you're looking at their cash balance, it looks like they've got basically they have like a pretty big issue in terms of the cash collect. It's like is the collection of the receivables an issue? The other thing that they go through and mention is like looking at this from a perspective of like a debt to equity ratio. So the other thing they could possibly go through and explore is that if they have this plant and equipment, they could do something called a sale leaseback, which is basically you take your existing equipment, you're selling it, and then you're leasing it back to yourself. By doing that, you're going to generate cash and you're going to be able to basically pay yourself back the part. So if they're going through and making heavy investments, they may be able to find a lender who would give them money to basically sell and then buy their own stuff back. So that could also go through and be a way that they could be going through and generating cash. So the other financial analyses you would go through and do, remember, qualitative, quantitative, you'd be looking at other ratios. Qualitative, you would be looking at the backgrounds of the officers. You'd also want to see the cash flow as well as the projected cash. Okay, assume that the percentage changes experienced in fiscal year 2021 as compared with 2020 for sales and cost of goods sold will be repeated in each of the next 2 years. Is Bradburn's desire to finance the plant expansion from internally generated funds realistic? Well, let's see what that exactly means. Okay, so if I come over here and if they say that, let's take a look. Okay, assume that the percentage changes in sales and cost of goods sold will be repeated over the next basically whatever number of years. So what that would mean is that for 2022, I would basically say, okay, for sales revenue, and then for cost of goods sold, for sales revenue, this would be 3 million times 1 plus this amount over here, or 3,333,000. So if it's on the same growth trajectory, for cost of goods sold, this is also going to be over here and increasing by so this is going to give me a gross margin of 1,695,096. For 2023, I would be looking at, again, the same kind of thing, 3,333,000 times 1 plus this percentage change here. And then over here, I would be looking at this times 1 times, or 1 plus 7.37. Okay, so I'm generating over here more gross margin, right? So here, my gross margin is basically increasing. So over here, my gross margin is increasing by 220. Over here, it's increasing by 249. So if I'm looking at this in terms of my plant expansion, it's estimated that the cash flow problems are due to the company's desire of 300,000 plant expansion over the next 2 fiscal years through internally generated funds. Well, they may be able to go through and to basically to go through and do it because their cash is going to be going up if it increases at the same rate, right? So if I'm looking at this in terms of talking about like free cash flow, and we like the net income is going up way more. But if I look at this over here, can these next 2 years cover 300 grand? And the answer is possibly yes. But we may want to look at other different like options in terms of, it says over here they should be able to finance it based on essentially by like the next page. And I think what they did a little bit differently than myself is we got the same numbers over here, but then they also did the operating expenses and then the basically like the net income. So when you look at this, they did a little bit more, and I'll go through and do this. I'll go ahead and do this for you because you've asked for it. So when we look at this over here, so we've got our gross margin, right? So what are going to be our operating expenses? Okay, so the operating expenses, if we are going to use the same type of analyses, right, which we did not go through and do before, let's go ahead and add some stuff in over here. So my operating expenses were over here for 2020, it was 780,000. This was 680,000, right? Okay, so then my income taxes. Okay, hold on. So my net income before income taxes, this is going to be 790 and 495. My income taxes, sorry, this is 860. Income taxes are going to be 40% of this amount. And that's getting me down to over here. So if the way the book is doing it, and I wish that they would have gone through and kind of told us to do this part of it just to be a little bit more transparent. So hold on. So if I'm looking at this over here, what you're going to kind of notice is that, okay, the other expenses here are kind of like, let's go through and do how these are kind of going up. So my operating expenses for 2021 were 860, and then we've got over here, we've got 780. So what would happen in 2022 with my operating expenses? Well, I would take my 2021 amount, I would then multiply it by the same change going forward of okay, so my net income before income taxes, this is going to be my gross margin minus my operating expenses. And then over here, you're going to basically get down to my income taxes. This is going to be this over here is going to be this times 40%. And then you're going to have here net income after tax. This over here is going to be 536, 445, 366, and 297. So if everything goes through and seems to be like headed on the same trajectory, then this part over here, this is what it would kind of go through and look like. Now, what's interesting here is that they're also taking into account that some of these things over here. So when it comes over here, depreciation charges on the plant and equipment of 100,000 for fiscal years ended are included in cost of goods sold. So what they're doing over here is they're saying, well, if you're really trying to figure out how much cash that you want to go through and add back, Okay, so this is looking at part of the free cash flow. However, over here, what we're also kind of looking at in terms of like this part, there was something cash dividends were paid at the rate of $1 per share in fiscal 2020 and $2 per share in fiscal 2021. So the question is here, they have 130,000 shares at $2 per share. So if they're going to pay the same amount of the dividends, this is going to be 130,000 shares times 2 per share. So this is going to be 260. Now, my question would be, is that if you're doing internal expansion, that's probably not a good time to pay dividends. However, it just depends on the board and everything else you have, but right over here. So my cash flow free would basically be the 139 minus the 260, the 547 minus the 260. So what they then say is like, well, if you're going to go through and spend 300 grand, right, your after cash flow from 2023 and 2022 are going to be these two numbers right over here. So I'm just going to show this to you. I'm really kind of going from their solution. And if we look at this right over here, you can kind of see that they have, I did it a little bit differently, but they're showing 2021. They're basically going through and assuming the same growth rates. You're adding back depreciation to net income because depreciation, remember, when we make that entry, we're debiting depreciation expense, and then we're crediting accumulated depreciation. So as I'm looking at this particular part right here, that's why they're going through and adding this back. And then you've got a note repayment for $6 grand that we missed. So let's just go ahead and put that in. Okay, so they're basically coming back over here, and they also have, if you notice, what are their assumptions? That sales increases at a rate of 11%, cost of goods sold increases at 7.37, and then over here, other operating expenses are also increasing at the same rate. Dividends remain at $2 per share. Plant expansion is financed equally over the 2 years, and then the loan extension is granted. So if I kind of come back over here and let's just take a look at our final part of this. So should Topeka grant the extension based on the notes about the financing through internally generated funds? And, honestly, if they're publicly traded and they don't have a lot, they don't have debt, right? So this is all, they're the primary debt holders. So if you give them an extension, it's not necessarily going to be the end of the world, provided they go through and they have these things. Also, part of this too is that if I give them the extension, if the company went bankrupt, I would be first in line after the attorneys, right? Because you've got this whole thing with, where do people fall in line and everything else. So again, would I go through and, how would that go through and work? It just depends on my securitization. So this is basically, hopefully this was helpful and not more confusing to you. Beth, I really appreciate you going through and asking me this question. It's a great question, but I think though that really what I would encourage you to kind of look at is that when it comes to financial statement analysis, it's really like doing something like this isn't really, this is kind of not the best exercise because you really need more information. And that's why I always encourage, I encourage my students. And in fact, what I do in my intermediate accounting classes is I have my students write a paper. So that's how I have my students basically go through and show their knowledge on this part of it. So hopefully, Beth, I hope this was helpful. And I look forward to seeing you on the next video. And I do want to give Wiley a huge shout out and a big thank you for allowing me to continue to make these videos. And I look forward to seeing you on the next video. Have a great day.